Good morning, everyone, and welcome to our Finance Focus webinar for finance directors. We are delighted to have so many of you join us this morning. So my name's Jennifer Williamson. I'm a partner at Kreston Reeves, and I will be chairing our session today. So thank you for taking the time to join us. We know that for most finance leaders, finding a spare hour in the diary is becoming increasingly difficult. Between economic uncertainty, regulatory change, workforce challenges, and the continual pressure to do more with less, there can rarely be a quiet moment. And perhaps you're also trying to keep one eye on the football and catch the odd match this summer. Well, it's been another year where finance teams have been navigating a rapidly changing environment. Interest rates remain higher than many businesses became accustomed to during the last decade. Inflation pressures haven't entirely disappeared, and working capital remains under scrutiny. And also regulators continue to increase their focus on compliance and reporting. And we recognise that against that backdrop, finance directors are expected to not only report on performance, but increasingly to help shape strategy and manage risk. Now, that's exactly why we've brought this webinar together today, to provide some practical insight into some key developments and challenges we're seeing across the finance landscape, and to help you identify opportunities and risks within your own organisations. But before we get into today's topics, I'd just like to briefly share an update about Kreston Reeves. Hopefully, as many of you will already know, Kreston Reeves has recently become part of the AAB group. And that marks an exciting new chapter for our firm, with Kreston Reeves becoming AAB's hub for London and the South East. Now, for our clients, it's very much business as usual. You'll continue working with the same trusted advisors and teams from the same offices, with the same commitment to delivering personal, relationship-led service you know us for. But what that change does bring is greater scale and capability, because as part of the wider AAB group, we're now able to offer access to an even broader range of specialist expertise and enhanced sector knowledge, with additional services from areas including global tax, wealth management, and people consultancy. Our combined organisation now brings together more than 1,800 people across 25 locations throughout the UK and Ireland, creating a stronger platform for continued investment in our people, our technology, and our client services. We're really excited about the opportunities this creates, not only for our business and our colleagues, but importantly for you, our clients. And we hope that today's webinar is just one example of our ongoing commitment to keeping you informed and helping you navigate the issues that matter most to your organisation. So with that context in mind, before we get started, let me run through a few quick housekeeping points. So firstly, today's webinar is being recorded, and we'll send you a recording after the session. So don't worry if you need to revisit any of the content or you'd like to share it with colleagues. You'll have that recording to hand. Secondly, we'll be running a number of polls throughout the webinar. These give us a really useful insight into what's happening within your organisation. So we'd love to encourage you to take part where you can. And finally, there will be a short feedback survey at the end of the session. We genuinely use your feedback when planning future events, so we'd be really grateful if you could spare just a couple of minutes to complete it. So before we get into the presentations, we'd like to have our first poll and get a sense of maybe what's keeping you awake at night. So let's start by finding out what is at the top of your agenda. So what is the biggest finance leadership priority over the next 12 months? Is it managing economic uncertainty, regulatory and reporting changes, tax planning and compliance, AI and finance transformation, or supporting business growth? I'm just going to give that a couple more seconds on screen for people to participate. Okay, Thanks very much, everyone. Well, that's an interesting result. We've got AI and finance and supporting business growth sort of tied, closely followed by managing economic uncertainty. So, it's striking that probably all of these priorities are interconnected. Economic conditions influence all these areas. So lots and lots for finance directors to think about, as we've already indicated. Thank you very much, everyone. Now, of course, we'd like you to get as much out of this session as possible. So let me quickly show you how you can ask questions throughout the webinar. We've already received a number of questions in advance, which is fantastic, but please do keep them coming throughout the session. So to ask a question, simply click the question icon shown on the screen and type your question into the panel. Now, please don't worry about waiting until the end or trying to remember your question later. Just send it in whenever it occurs to you, and we'll answer as many as we can at the end of the presentations through the panel discussion. And if we don't manage to get to your question during the session, then one of our team will follow up afterwards. So whilst you're just finding that function, let me give you a quick overview of what we'll be covering this morning. So we're going to begin with an economic update. We're then going to move into the audit landscape, where Graham Gardner will look at some of the developments affecting financial reporting, audit requirements, and assurance. After that, Sam Jones is going to cover a number of corporate tax hot topics before exploring some practical tax structuring and incentive opportunities that businesses are considering in the current environment. And finally, James Hopkirk will be using some practical case studies to discuss business advisory and risk management, focusing on some of the warning signs, governance considerations, and strategic decisions that finance leaders may need to address. So with that, just like to turn to introducing you to those speakers who'll be joining us today. So Graham Gardner, Partner and Head of Audit Quality, Sam Jones, Partner and Head of Corporate Tax, James Hopkirk, Restructuring Partner. So as you can imagine, between them, they work with businesses across a wide range of sectors and bring experience spanning economic insight, audit and assurance, tax strategy, restructuring and risk management. They're all very close to the issues currently affecting organisations, so we're really looking forward to hearing their perspectives and answering your questions later in the session. Graham.
Hello.
Yes,
Hello.
perfect. Wonderful. Over to you, Graham.
There we go. Good morning, everyone. I'm a massive fan of an audit being both efficient and effective, and there's a number of items within the current audit landscape that will impact that. So I'm going to cover just 5 points in the next few slides that will be relevant to you as finance teams in preparing for your audits. Firstly, audit reform has slowed. Following the recommendations of the Bryden, Kingman, and CMA reviews, which happened a few years ago, the government originally had proposed significant reforms in the UK audit market. And this was planned by the previous government as well as the current Labour government. And these reforms included replacing the FRC with a much new, more powerful regulator called the Audit Reporting and Governance Authority, or ARGA, and they would have greater powers over audit firms and over company directors. Now, much of this legislation has been postponed or removed from the government's legislative program. But this doesn't mean that companies are unlikely to see fundamental changes to the legal framework governing audit in the near future. And shouldn't be interpreted as a relaxation of regulatory expectations. The FRC is still the regulator. They are still committed to improving audit quality across the market. And we have our regulatory supervisory bodies such as the ICAW or ICAS who come and do reviews as well. And these sorts of bodies publish thematic reviews and continue to make updates to audit standards, all with the continued focus on improving audit quality. So as a result, audit firms must continue to invest heavily in our methodology, our training, our quality management, and ultimately the quality of the end product that we produce. So finance teams shouldn't expect audits to become easier simply because of this stalling of the wider audit reform. And audits will still be robust, and auditors will continue to look for ever increasing levels of evidence and justification for your assumptions. Next slide. There has been an increase in the audit exemptions. You may have noted this from last year. Um, it it came into effect on the 6th of April 2025. But worth a recap, the turnover threshold increased from 10.2 million to 15 million. The gross assets threshold increased similarly from 5.1 million up to 7.5 million, so roughly 50% up on both those measures. The employee threshold remained the same at 50 employees, but as a result of those size thresholds, a number of companies that previously required a statutory audit may now qualify for an audit exemption. And as the finance team, you should consider whether you still require an audit per the regulations. However, it's also important to remember that qualifying for an exemption doesn't necessarily mean you don't need an audit, because there may be other reasons why you would voluntarily have an audit. For example, as requirement from lenders, investors, or overseas parent companies, grant providers, shareholders. It may be within your company deeds. If you're close to these new audit thresholds, again, I would advise that you review whether you require a statutory audit. And if you determine that you do not require a statutory audit, have a think about whether you still need one. Next slide, please. There is a greater emphasis at the moment on proportionate audits for SMEs. Many of you will be caught by this sort of program. And it's one of the recurring criticisms of the audit profession, actually, that methodologies are developed for large listed companies and they're applied by a whole firm. But it's fit for purpose for the largest, and it needs to be fit for purpose for the largest clients. However, the same thing is applied across the board, which means that the smallest of audits aren't particularly scalable or efficient. This is something that the ICAW have noted, and it's something that the FRC have noted and recognized. And they've recently published additional guidance for auditors, which us as Kreston Reeves were involved in to a degree. This is under something called Practice Note 28. It goes to the various elements of an audit and discusses how auditors may scale some of the requirements and deliver a more proportionate audit. Now, one of the challenges is that we still need to comply with the audit standards in full. And the audit standards themselves, while saying they are to be applied proportionately, aren't particularly scalable. There is a minimum number of requirements that are there. For this reason, the FRC hasn't adopted something called the ISIS for less complex entities, which is a global standard but not adopted in the UK. They do not believe it's fit for purpose. So where are we then? As auditors, we are looking at ways that we can apply the standards, but in a more proportional way, using different types of documentation. So not looking at full checklists, kind of scaling back on questions and items that we are documenting which weren't actually relevant to the particular audit, and also looking at how we deliver our procedures. And we'll talk a little about data analytics and AI in a minute, but delivering better procedures that get through the audit process quicker. Okay, so as a well-managed SME with straightforward operations, you should increasingly see that audits focus on the areas of genuine risk within your entity and avoid unnecessary documentation and testing, and hopefully end up being more efficient. Next slide, please. I mentioned new standards. Now, there are two that have changed. These are UK standards, so ISO 240, which relates to fraud, and ISO 570, which relates to going concern. The good thing up front is that the UK specific standards for both of these were actually ahead of where the global standards were. Now, the global standards have been changed and essentially moved up a gear. They are effectively at the level of what we had already been doing in the UK. This means that the changes in the UK standards are quite minor, but there's a couple things to note. Firstly, the fraud standard now promotes an ongoing discussion of fraud, though with yourselves as the entity, throughout the piece, and enhance the responsibility of the engagement partner for considering whether we need to get fraud-specific expertise. Okay. The standard on going concern places far greater emphasis on the review of management's going concern assessment. The auditor is required to review your going concern assessment, and if you don't have one, they are required by the standards to ask you to produce one. Okay? What you should expect to see, therefore, is a lot more challenge on your assessment of going concern. And ideally, you should look to do this earlier. One of the issues that we see is this is provided to the audit team quite late in the audit, and equally auditors are looking at this quite late in the audit, but it's fundamental to the entire accounts preparation process. And so auditors now are being forced, rightly so, to look at this a lot earlier in the process, and it would be really helpful if their entities provided them with the going concern assumption earlier, so that we can all avoid any last minute changes or questions coming at the 11th hour, that this doesn't lead to a very efficient audit. And if your auditors aren't asking you for areas of significant risk like this earlier in the process, you should probably nudge them about that. Yeah. Next slide. As standard for any discussion these days, let's talk about artificial intelligence and technology. So the audit profession is increasingly adopting data analytics. This has been something that's been ongoing for the last decade. And as part of that, there will be machine learning and generative AI has come to the fold in recent years. And all this is an attempt to improve audit quality as well as audit efficiency. So the trend we've seen is towards the use of these tools, as I said, over the last decade. However, this is very much accelerated in the last couple of years because of the accessibility of the sorts of tooling, particular to medium-sized and smaller audit firms. Large firms may have had a lot more of this tooling in the past, but this wouldn't have been as accessible to the smaller audit firms. And now, with things like generative AI and with much more coming out of external providers, we're seeing this adopted a lot more throughout the profession. Okay, and these technologies are being used to analyze complete populations of transactions. For example, looking at all your journal entries, to summarize large volumes of documentation. They also assist with financial statement reviews and to automate routine areas of the audit. It's really important to note that the use of this data analytics and AI in particular doesn't replace professional judgments of the auditor. We always need to have the human in the loop. We always have the responsibility resting with the auditors, and they must develop their own conclusions and validate the outputs that are produced by their tooling. But this is allowing auditors to spend less time on the repetitive, more administrative type tasks and more time on doing the tasks that matter, exercising challenge of your judgments, having discussions with you, adding value through the audit process by that critical evaluation of the accounting being done. Okay. Now, the impact of all this on yourselves is that you should expect the auditors to be making more extensive requests for data, and looking for evidence in a digital format, so things in PDFs, for example. And businesses with well-structured accounting systems and good electronic data are then going to be able to experience a more efficient audit. Entities which have poor quality data aren't going to be able to benefit from the use of this tooling by auditors, because the auditor either needs to take a lot more time in cleansing that data to get it into their tooling, or they need to revert back to the old, more manual processes. Okay, so have a think when you're preparing for your audit to what data you're able to pull out of the system, and whether there's a need to consult your own IT people to get this data out in a good, reliable format for your audit teams. Okay, I shall hand back to Jen now. Thank you all for your attention, and I look forward to any questions.
Thank you, Graham. So it's very clear that whilst audit reform may have slowed somewhat, those reporting requirements and expectations certain haven't. So I'm just going to pop back on screen now how to ask a question as a reminder. So as a reminder, you just simply click on the question icons shown on the screen and type your question into the panel. Do that whenever a question arises in your mind, and we'll do our best to come to it at the end of the presentations. So we're going to move on to another poll now. We're interested in understanding where you see the greatest opportunity for your auditor to add value beyond the statutory requirement. So what are the key challenges or priorities where support from your external auditor could make the biggest impact? Earlier planning and communication, practical accounting and financial reporting advice, insights into business risk and controls, updates on changes in regulation, or greater use of technology to reduce audit disruption. Got some level pegging, or something's going slightly ahead. Okay, so the most popular answer there is practical accounting and financial reporting. So I'm not necessarily surprised to see that. There are changes in reporting and developments, I guess increasing reporting expectations. So I guess many finance teams will be looking for that practical guidance rather than simply compliance and reviews. Thank you very much, everyone, for those insights.
So good morning, everyone, and thank you for joining. This session, I'm going to look at corporate tax hot topics. So looking at the corporate tax landscape, the headline message is actually one of stability. Corporate tax rates remain unchanged, with the main CT rate at 25% and the small profits rate at 19%, with marginal relief in between. Capital allowances also remain broadly consistent with no major structural changes. The AIA remains at £1 million, with full expensing relief available for new plant and machinery acquired. Whilst tax legislation is always evolving, we're not currently seeing the sort of corporate tax changes that require finance leaders to rethink their overall tax strategy. However, there is one area that is catching out a surprising number of companies, and that's the timing of corporate tax payments. We're regularly seeing companies miss quarterly instalment payment obligations. Particularly where profits have grown quickly, there has been a one-off transaction such as a capital gain, or groups haven't fully considered the impact of associated companies on the thresholds. Historically, some businesses viewed late payment interest as relatively insignificant when the interest rates were low. However, HMRC interest rates are now at a level where getting payment dates wrong can become an expensive mistake, with late payment interest rates up to 7.75%. My recommendation is to make sure your corporate tax payment dates are being actively monitored and diarised, particularly if your business is growing, making acquisitions, or experiencing unusual profit levels. Let's look at when QIPs apply in a bit more detail on the next slide. For large companies, QIPs can apply where taxable profits exceed 1.5 million. The 1.5 million threshold is adjusted for associated companies. Associated companies are generally group companies and those under common control. Large companies pay their quarterly instalment payments in months 7, 10, 13 and 16. Whereas very large companies, the threshold is £20 million and the payments are accelerated even further, with all payments being made in year being months 3, 6, 9 and 12. The issue is that many businesses don't realise they've just tripped the thresholds until it's too late. For example, your accountant may notice when preparing your accounts and the first instalment payments for the following year are often already late. The cash flow impact can be quite dramatic because you're not just paying tax earlier. In some cases, you're effectively paying tax for multiple accounting periods within a relatively short time frame. The example on this slide illustrates the point. A company within a group of 4 companies grows rapidly to £2 million profits. In the 2025 year, the corporate tax liability is payable under the normal rules, so 9 months after the year end. This is because there is a 1 year's grace period for tripping the large company threshold. But once QIPs are triggered, the following year can involve the final payment for the previous year, being the 9 months, and alongside instalment payments for the current year in months 7 and 10. So you could have 3 corporate tax payments within a very short time period. We've seen businesses caught off guard by this. The tax liability itself isn't higher, but the timing of the payment changes significantly, and that can put real pressure on working capital. If your business is growing or is near the thresholds, review your expected profit levels early. consider the impact of associated companies, and make sure that corporate tax dates are diarised and built into your cash flow forecasting. The next area I want to highlight is a potentially significant change in tax administration and reporting. HMRC is currently consulting on new reporting requirements for close companies. In practice, that would affect a large proportion of owner-managed businesses. HMRC wants greater visibility over how value is extracted from private companies and is looking to modernise a reporting framework that has mainly remained unchanged for many years. Under the proposals, companies may need to report far more information about transactions involving shareholders and participators. That could include loans, loan repayments, write-offs, dividends, capital withdrawals, and transfer of assets between companies and its owners. Importantly, the consultation suggests reporting would potentially be required on a transaction-by-transaction basis, including details such as the recipient, amount, the date of the transaction, which will then likely be linked up to the shareholder's personal tax returns. At the moment, this information is only reported in relatively limited circumstances, for example, where directors' loans remain outstanding at the year-end. The proposal would move towards a much broader and more continuous reporting framework. From HMRC's perspective, this is about reducing the tax gap and increasing transparency around profit extraction. It means generally more record keeping, more reporting, and greater scrutiny of transactions between businesses and their shareholders. At the moment, I wouldn't say anyone needs to panic. This is still a consultation rather than a final set of rules. However, it's a useful reminder that transactions involving shareholders should be properly documented and recorded, because the information HMRC may ask for in future could be far more detailed than it is today, especially where loan accounts are utilised throughout the year and then cleared by a final dividend. The tax may not change, but the reporting burden very well might. I'm going to finish off on a brief update on international tax. For many of you, international tax can feel like a topic that only affects the very largest multinational groups. While that's certainly true for some areas such as Pillar 2, we're increasingly seeing that international tax issues impact mid-market businesses as they expand overseas. The first area I'm going to touch on is Pillar 2. This does apply to the very largest multinational enterprises, being those with a group turnover in excess of 750 million euros. The global minimum tax rate of 15% is now in force, and effective groups face significant additional compliance and reporting requirements. In reality, for many businesses, the challenge isn't the tax itself, it's gathering the data and producing the required calculations and disclosures. We've just passed the first deadline for Pillar 2 reporting, and it's become clear that international groups are not on top of the requirements in every jurisdiction, resulting in last-minute panic to gather the required information and avoid penalties. This is especially true for US-headed groups, as the US has not adopted the Pillar 2 requirements as most other jurisdictions have. We're also seeing transfer pricing become much more important. HMRC continues to focus its mind on transfer pricing, and businesses need to be able to demonstrate that transactions between group companies are taking place on commercial terms and are properly documented. The scope of the rules have widened, so more relationships may now fall within transfer pricing due to the inclusion of a broader participation condition. In practice, UK transfer pricing can now apply even where formal legal control is not obvious. For example, where one party has enough practical influence over another. One sigh of relief is UK to UK transfer pricing is now exempt, but only where the exemption applies. This means that both companies need to be paying tax at the same rate of CT to ensure that the tax is tax neutral on both sides. So we cannot just ignore UK to UK transactions as part of the transfer pricing review. The other change to note is the potential inclusion of the International Controlled Transaction Schedule. The government proposes a new requirement for certain businesses to report cross-border related party transactions directly to HMRC. The information will be disclosed via a portal. There will be de minimis limits on the value of transactions to be reported. My My recommendation is to make sure you review all of your transfer pricing documentation and that this is all up to date for all international group transactions. Another area we've seen a change is for foreign permanent establishments or branches. Historically, UK companies could elect into the permanent establishment exemption, meaning profits of overseas branches were exempt from UK corporate tax. However, the government is now proposing to make exemption mandatory from 2027. This means overseas branch profits would generally be outside the UK tax net, but equally relief for overseas branch losses would no longer be available in the UK. It's clear that the UK continues to move towards a more territorial tax system, with profits being taxed where activities take place rather than being brought into the UK tax comp. Businesses currently relying on UK relief for overseas branch losses will see a different tax outcome in future, while those with profitable overseas operations may benefit from greater certainty and simplification. Finally, withholding taxes remain a common trap for businesses. We continue to see businesses make overseas interest, royalty and other payments without fully considering whether a withholding tax obligation exists or whether treaty relief needs to be claimed before a payment is made. A warning: HMRC has paused a long-standing concession that dealt with administrative failures to withhold with income tax from payments of UK-sourced yearly interest to overseas lenders. The concession allowed borrowers to make a voluntary disclosure and in qualifying cases be assessed only for late payment interest. The concession applied where UK borrower had not obtained HMRC clearance to pay interest gross and paid an amount of interest gross, but where the overseas lender was entitled to relief under a double tax agreement. HMRC has suspended this pragmatic approach while it reviews processes where a double tax treaty modifies the requirement to withhold on cross-border interest. Make sure you have treaty relief formally claimed before making any payments of interest or royalties overseas, or HMRC will expect the default UK withholding tax rate to be paid, which is currently 20%, soon to be 22%, even if a lower rate is available under the treaty. This results in unnecessary tax being payable and you won't be able to get a refund. The common theme for all of these changes is greater transparency. HMRC and tax authorities globally want more information, more reporting, more visibility over cross-border transactions and profit flows. So my advice to you is not simply to focus on the tax risk, but also the reporting risk. That's all from me on CT Hot Topics, and I will now be looking at tax structuring and incentives. The next topic is group rationalisation, and it's something we're seeing more frequently in the current market. Many groups have grown organically over a number of years through acquisition, historic projects, or changes in strategy. As a result, it's not unusual to find a group structure containing dormant companies, legacy subsidiaries, or entities that no longer serve a clear commercial purpose. In a period where finance teams are under pressure to reduce costs and improve efficiency, many businesses are questioning whether those entities still justify the admin burden that comes with maintaining them. The drivers are usually quite straightforward: reducing compliance costs, simplifying governance, improving financial reporting, and preparing the business for a future transaction, refinancing, or investment event. However, while simplification makes good commercial sense, it's also important not to underestimate the tax considerations. Within a UK group, assets can often be transferred under the no gain, no loss rules, allowing businesses to reorganise relatively efficiently. But it's important to understand where historic gains sit within the group and whether future degrouping charges could arise if companies leave the group at a later date. We're also seeing businesses review whether the substantial shareholdings and exemption, or SSE, is available on future disposals. Looking at intercompany balances that might need tidying up, whether certain entities can be eliminated altogether, reduce admin and filing requirements. In reality, group rationalisation is often less about tax planning and more about creating a cleaner, easier to manage structure that supports the long-term objectives of the business. And where it can add real value is transaction readiness. Buyers, lenders, investors generally prefer simple structures, clear ownership chains, and well-managed intercompany arrangements. The earlier those issues are addressed, the easier future transactions tend to be. My recommendation is to periodically review your group structure and ask a simple question. If we were building this group today, would it look like this? If the answer is no, it may be time to consider a rationalisation project. Even if a sale isn't on the immediate horizon, the businesses that achieve the best outcomes tend to be the ones that prepare several years in advance and not several months. Starting with a disposal strategy, one of the first questions is whether the future exit is likely to be structured as a share sale or an asset sale. That decision can have a significant impact on the tax outcome, buyer appetite, and ultimately the net proceeds received by the shareholders. The second consideration is relief optimization. Relief such as SSE on the sale of a trading subsidiary, is it available? Shareholders' relief such as business asset disposal relief and EMI can materially reduce the tax cost of an exit. These are dependent on which entity is sold. Is it the topco or just part of your group? Then you need to consider where the proceeds actually flow. However, many of these reliefs require forward planning and can be difficult or impossible to fix once a transaction is underway. The third area is group structure. We often see valuable trading businesses sitting alongside investment properties such as surplus cash or non-core activities. Separating those assets can make the business more attractive to a buyer and provide more flexibility when negotiating a transaction. Next is balance sheet readiness. Buyers will scrutinise intercompany balances, historic transactions, and trapped cash positions during due diligence. Addressing those issues early can remove deal friction and reduce the risk of value leakage later in the process. On ownership structure, minority shareholders, outdated shareholder agreements, or historic incentive arrangements can all become obstacles during a transaction. Resolving them before a deal process begins generally leads to a smoother and quicker execution. The common theme across all of these areas is that preparation creates options. Whether you're looking to sell, attract investment, undertake a management buyout, or simply keep strategic options open, businesses that address these issues early tend to have a more flexible, stronger negotiating position and ultimately better outcomes. Don't wait until a transaction is on the table or a buyer finds you. Review the structure now and identify what a buyer, investor, or lender is likely to focus on. The earlier those issues are addressed, the easier any future transaction becomes. So, following on from transaction readiness, another topic I'd like to touch on is a consultation that I think could have the most significant long-term implications for business owners. HMRC is currently reviewing the way distributions and returns of capitals are taxed. This was only released a couple of weeks ago. The reason is that many of the core rules date back to the 1960s, and HMRC believes they no longer properly reflect the way modern businesses are structured and how shareholders extract value from the business. Importantly, this doesn't just look at dividends. The consultation is much broader and looks at the tax treatment of capital repayments, share buybacks, company reorganisations, demergers, liquidations, and other forms of value extraction. The key concern from HMRC is what is economically income is being taxed as capital. Over the last decade, we've seen a growing number of transactions involving holdco insertions, capital reductions, share buybacks, demergers, and pre-sale planning exercises. Many of these are entirely legitimate commercial transactions, but HMRC believes the legislation has become increasingly complex and can produce inconsistent outcomes. For business owners, there are three areas I'd like to focus on. First, share buybacks. Currently, these can often attract capital treatment where certain conditions are met. HMRC is questioning whether some of those transactions are, in substance, and simply an alternative way of extracting retained profits, and may tighten the rules to complete exits on retirements only. So currently we might use them for a partial exit. As long as someone has substantially reduced their shareholding, they can still retain a small amount of shares. But this is going to be completely tightened to complete exits. Second, group reorganisations and demergers. Many businesses use these to separate activities, prepare investment, or facilitate succession planning. So that might be where you might want to retain investment assets but sell your trading business. HMRC is considering preventing companies from implementing tax-neutral demergers using the capital reduction route, instead requiring that new statutory conditions are met before demerger relief is available. We don't know what they're going to look like just yet. And third, family-owned and international groups. Businesses with complex ownership structures or long-standing accumulated reserves may find that future extraction strategies become more restricted. Now, I should stress again, this is only a consultation. We don't have draft legislation, and there is considerable uncertainty about where the government will ultimately land. However, we can see HMO is looking to reduce situations where value can leave a company and receive capital treatment rather than income treatment. If your business is considering a share buyback, a demerger, group reorg, succession plan or sale over the next few years, it is worth reviewing those plans sooner rather than later. The current rules remain available today, but the landscape could look quite different in the future. With all the talk of tax strategies, I want to touch on staff incentivisation. One of the most common challenges we hear from clients is how to attract, retain and motivate key people in an increasingly competitive market. Pay rises and cash bonuses remain important, but these generally reward past performance. Many businesses are looking for tax-efficient ways to align senior employees with long-term growth. That is where share-based incentives, particularly EMI or Enterprise Management Incentive options, continue to be incredibly attractive. EMI allows businesses to provide employees with an opportunity to participate in future growth without necessarily giving away shares today. Provided the conditions are met, there is generally no income tax or national insurance on grant, and gains can often be taxed at much more favourably on exit as CGT rates, probably benefiting from business asset disposal relief too. Beyond the tax advantages, EMI can be a powerful retention tool because it creates direct alignment between management and shareholders. Everyone benefits from the increasing value of the business. In addition, the management team do not become shareholders until a certain event has been met, such as an exit, time they've worked for the business, or a growth target has been met. By contrast, bonuses remain simple and flexible. They are easy to implement, require no changes to future ownership, and can be an effective way to reward strong performance. However, the downside is that bonuses are generally subject to income tax and national insurance, making them one of the least tax-efficient ways of extracting value for the business. Increasingly, we're seeing businesses use a combination of the two. Annual bonuses to reward short-term performance and EMI or other share incentives to drive long-term value creation. The key point is that there is no one-size-fits-all solution. The right incentive structure depends on your growth plans, shareholder objectives, and the individuals you're trying to retain. But for many businesses, particularly those ahead of a future investment round or an exit, now is a good time to review whether owner-based incentives could deliver a better commercial and tax outcome simply than increasing remuneration. So there's a lot there to think about, and lots of things that I'm just sort of thinking you should think about what the future is for your business, think about your strategy and whether there's something you should be doing now to benefit from the tax reliefs that are available now. So that's all from me, and I'm going to hand back to Jen.
Thank you very much, Sam. So I think one thing we've learned from that is that tax legislation is never accused of getting any simpler. We're going to move on to our poll now for you all to participate in. We've heard about a range of reliefs, incentives and potential pitfalls from Sam this morning. So let's see how confident everyone feels about their current position. So how confident are you that your business is taking advantage of all the available tax reliefs and incentives. Very confident, fairly confident, I'm sure. Not very confident or not at all confident. Just going to leave that there a little bit longer to get as much participation as possible. Okay, so fairly confident. That's a good result. Suggests that many of you have got a good handle on the opportunities available to you. We recognise that tax is one of those areas that even confident organisations can benefit from a periodic review. So we're always here to help, and anyone who needs any help in what Sam's discussed today, please do reach out. Okay, so we're going to skip on to introduce my colleague James Hopkirk from our restructuring team, who's going to talk about business advisory and risk management. Over to you, James.
Thanks very much, Jen. Hopefully you can hear me okay. So in the restructuring team at Kreston Reeves, we often deal with clients who are trying to overcome some kind of adversity, but we also assist clients who are very much solvent in tidying up group structures in different ways. So over the next 10 minutes or so, I'm going to cover a couple of areas that I thought may have some relevance to this audience. So first slide, good. So we're going to look at a situation here where a company is struggling. So to keep things relevant to you, it may help to look at this through the lens of an acquisition. So imagine you've identified a target company and you'd like to acquire. You've done some due diligence that's raised some red flags. There might be declining reserves for dividends, mounting tax liabilities, over-reliance on short-term borrowing, high staff turnover. But your company decides to acquire the target company at a good price, and the business is now a subsidiary in your group. Perhaps one of your directors is now sitting on the board of the acquired company. So the founding directors might remain hugely optimistic, but the challenge here is to carry out the required structural or operational changes whilst ensuring the directors aren't at risk of personal claims if the company did ultimately fail. So the key consideration for the directors is about wrongful trading, which means continuing to trade after a liquidation becomes inevitable. So that situation can give rise to personal claims against directors. So we'll think about what can be done to mitigate the risks. So typically we can monitor the position carefully and frequently. So this will allow directors to pick up on any indicators that the company may be facing difficulties in the future. We can scrutinize assumptions. It can be very tempting to rely on sales teams' optimistic forecasts, but is it realistic or achievable? We can assess the impact of changing circumstances, e.g., are any customer contracts due for renewal, and what would happen if they aren't renewed? And finally, we can record decisions. The best defense against any future criticism is to record the discussions that were held and what information was available at the time that the decisions were made. So next slide. So this just is an illustration, really. The graph is what I'd be used to looking at for a company facing distress. This forecast is from an actual assignment, which I'm going to elaborate on in a quick case study. The different lines indicate the impact of variations of revenue growth, cost savings, and asset sales. So the directors need a reasonable rationale for continuing to trade, and that means having a realistic pathway away from an inevitable insolvency. So how does that work in practice? We dealt with a charity which had some investment assets but a real lack of liquidity. Forecast per the last slide showed a cash crunch to come, and whilst this was a charity, the principles apply equally to a normal corporate business. So the management team had set out a strategy to save costs, improve turnover, dispose of assets, and they had to convince the trustees of the charity that the plan was actually workable. So we'll focus on some of the assumptions that were made when preparing the forecasts and making a decision at the time. So the assumptions, were along the lines of, are the increase in sales realistic? Are the cost-cutting steps actionable? How quickly should they expect to sell the investment property that they had? and they were looking to exit one leased property. How likely is it that their landlord will offer debt forgiveness when exiting the lease? Business owners or trustees of a charity will invariably have a degree of optimism embedded in their approach, but part of my role is to give a dose of the professional skepticism, as I call it. So the charity had managed to sign up a lucrative contract which provided an enhanced baseline for their sales projections. Some of the trustees were keen to model future organic growth at a certain percentage, but the more pessimistic approach the trustees took to their forecasting would lead to more protection should they have any future claims against them if things go wrong. In terms of cost cutting, the trustees were talking about making redundancies and cutting down some senior roles in the business. It was necessary to check that the trustees as a group were happy to implement those changes and that severance costs had properly been factored in. A key discussion point when I met the trustees related to the sale of the investment property. A quick sale had been crucial to keeping the finances above zero. The trustees had estimated that the sale proceeds would be received in 8 weeks, even though marketing hadn't begun at that point. So certain trustees were very optimistic and others less so. My role really was to advise on where the reasonable middle ground lay. The other main red flag for me was that the trustees wanted to exit a lease, and they had assumed that the landlord would be happy to forgo any future rent or rights to dilapidations. This was broadly on the basis that the landlord was also a charity and wouldn't want to see our client fail. We recommended that the trustees speak to the landlord to gain a realistic understanding of what liability might be incurred in exiting the lease and what the trustees might be able to do to mitigate that, e.g. could they help find a new tenant. So in the event, we were able to produce a forecast based on reasonable assumptions, which showed that the charity could navigate through the uncertainty and pay its debts. Therefore, the trustees unanimously resolved that the forecast should be relied upon, and it was reasonable at the time to conclude the charity would be able to pay its debts. Keeping our eye on the prize, the overriding objective here was to protect the trustees from any claims they might face if the charity does enter liquidation at some point. It was therefore very important that all the trustees were on board with a decision to continue. Again, the best defence against a claim from a liquidator is to keep contemporaneous notes of the decision-making process. And in those, they should be clear what assumptions were and why we thought they were reasonable. Note down any objections, challenges, dissenting voices, record actions taken to make the assumptions more robust, record what professional advice was taken, and of course, including the forecasts which are derived from the reasonable assumptions within that record. Okay, next slide. So moving on from that to something different, a separate thing my team does is to assist basically in tidying group structures. So some businesses are structured in a way that there are subsidiaries which serve a certain purpose. Once that purpose is achieved, the subsidiary can remain dormant in the group until some action is taken to remove them. If this isn't managed proactively, then it can become an additional burden to the group in terms of administration and costs. Broadly speaking, there are 2 routes to dissolving the company. First one is filing a strike-off notice, and the second one is placing the company into a solvent liquidation. And just to confirm here, we're talking about companies that have paid all of their debts. There's no unpaid liabilities here. So in terms of the strike-off notice, there are some positives. It's much cheaper, it's much quicker process overall. It is cheaper than a formal liquidation, and it's a simpler process. Directors could file the relevant paperwork themselves. But there are some negatives. There is potential for someone to object to a strike-off, sometimes HMRC, and it can be difficult to identify the objector and then engage with them. It could be perceived there is a lack of transparency. There's no clear indication in the public domain that the company was solvent when it closed. And the company could be restored to the register if a creditor came out of the woodwork after the dissolution happened. So similarly, there are positives and negatives of using the solvent liquidation route. So positives, there is the transparency. Company's house records will show that the company was solvent and paid everything. There's a formal process for flushing out claims prior to distribution of any funds to shareholders and prior to the ultimate dissolution. And that last point reduces the risk of the company being restored to the register later. In terms of negatives, there is a level of professional fees, and whilst the companies can enter liquidation quickly, it can take many months to conclude the liquidation and eventually dissolve it from the register. In terms of process, the cornerstone of a solvent liquidation is the declaration of solvency made by directors in front of a solicitor, confirming that the company can pay all of its debts. The directors recommend to shareholders that they pass a resolution to wind up the company and appoint liquidators. And the liquidator would act alongside the group's accountants to basically project manage the phase from cessation of trade to the appointment of liquidators, and then ultimately to the distribution of the assets. So next and final slide. So just another brief case study to illustrate that. We had a subsidiary in a large group which carried out civil engineering projects, and they finished some time ago, so the company had served its purpose. Significant retentions were then received a couple of years after cessation, and they needed to be paid up to the parent company. The board was keen to use the solvent liquidation route, as transparency was important to them for reputational reasons. And although the company had not had any issues with unexpected claims, the directors were keen that should any issues arise, that there was a formal mechanism to deal with them. So it was considered whether there was an option to pay funds to the parent company prior to liquidation to avoid the need for the liquidator to hold on to the funds for any period of time. However, in this particular case, the company had a large share capital and negative P&L, so dividends weren't immediately possible. A capital reduction was considered to allow dividends to be paid, but that was discounted as an option, as it would come with another layer of cost, and the directors would still have wanted to use the solvent liquidation for the other reasons mentioned. Clients are always keen to ensure this exercise is carried out quickly and efficiently once they've engaged us. So in this case, the cessation accounts were straightforward, completed by the group's internal finance team. The liquidation commenced around 2 weeks after the final accounts were signed off, and then we paid an initial distribution of the majority of funds within 2 weeks of the commencement of the liquidation. So, and then ordinarily a smaller final distribution would be paid once the liquidation is ready to be concluded. So that brings my contribution to a close. Thank you for listening, and I hope what I've covered has been helpful.
Thank you very much, James. So I think throughout today's presentations, we've discussed growth opportunities, regulatory developments, and tax planning. But ultimately, all those things rely on effective decision-making and good governance. So for our final poll, we'd like to understand what's most likely to be occupying boardroom conversations over the next year. So which strategic initiative is most likely to feature on your board agenda in the next 12 months? Improving financial performance and margins, investing in finance systems and AIs, raising finance or growing or supporting growth, acquisition or disposal strategy, or strengthening governance and risk management. Thank you very much. We've got a clear vote ahead there. Maybe not surprising given the audience, but improving financial performance and margin, by far and away the most popular response there. I mean, it's not surprising in a world where costs remain under pressure that improving profitability remains one of the most direct ways that businesses can strengthen resilience and perhaps create those future opportunities for growth. So thank you very much for your insights there. So I'd like to thank our panel for their presentations today. It's always interesting to see how closely the polls that we ask you to participate in align with what we're hearing from our clients and businesses across the region. We've covered a lot of ground this morning, but it's now time to hear from you. We've had some excellent questions submitted in advance and plenty more coming in during the session. So I'd just like to invite all of our panelists to turn their cameras back on and join me for our live Q&A session. Welcome back. Okay, so our first question is for you, Sam. This question comes from Stephen. Stephen has said, we're a family-owned business where several shareholders are also directors. Are HMRC inquiries into close company transactions becoming more common? And are there any areas finance teams should be reviewing now?
Thank you, Jen. So I don't think necessarily it's the HMRC inquiries that we're seeing at the moment, but we can see a clear direction of travel. So the tax gap with HMRC, they reckon 60% of the tax gap is due to owner managed businesses. So the consultation that's been announced is obviously trying to close that gap and increase the reporting around that. So I suspect the main things they're going to be looking at are those transactions between those individuals. And when we make those reports as to what those transactions are, you would actually need to link it to a specific person, including their national insurance number, so HMRC can start tying up what payments are going to the shareholders and what's actually being reported on the shareholders' tax return. I'd recommend actually the main thing to do is perhaps it's time to review your dividend versus remuneration strategy, because I doubt that salaries will need to be reported because it'll be caught under the RTI information. I think the tax difference between dividends versus salaries now is significantly smaller. So actually it might be easier to perhaps review how you're remunerating those individuals and perhaps then minimising the amount you might need to report in the future. And I think it's just catching the areas where people are perhaps underreporting the income they're receiving or over exaggerating the expenses. So I think it's just a good time to review, because we can see that the way that HMRC are going, and then it's minimising your admin burden going forward.
Thanks very much, Sam. Hopefully that's been useful to you, Stephen, in your question. We've got another question that's come in. Graham, it's for you to answer this one. It's come in from Christopher, who's asked, we're just under the new audit threshold now. Is there any real benefit to keeping an audit if we don't actually need one anymore?
Well, it depends what you would like to use the audit for. So there may be a requirement by a bank, if you're organizing significant lending, that they have a set of audited financial statements. I say may because I don't think it's as widespread as it used to be. And I think banks are more focused on the overall quality of the package, not necessarily whether it's audited or unaudited. As an audit person myself, I believe in the audit product, and I think what you get out of an audit as a finance team is independent challenge of the assumptions that you're making, which impact your business. So, for example, if you're looking at things like impairment of assets or going concern, the auditor should absolutely be challenging you on all the assumptions within that, and the output of that may make you realize that different directions need to be taken from what you had planned. So getting that extra set of eyes, I think, is incredibly valuable as finance people or owners of a business.
I don't think we'd expect you to say anything different, Graham. Thank you very much. And I think it's worth adding that we do see quite a number of clients have voluntary audits, don't we? Whether that's because of the type of businesses they work with. So some government organisations sort of require an audit for the tenders, or indeed, you know, particularly sometimes when there's multiple shareholders, and it provides that extra level of assurance to those stakeholders that process has been undertaken. Thanks very much, Graham. James, I'm going to raise one for you now. This has come in from Jill. Jill says, our group has accumulated a number of dormant subsidiaries over the years following acquisitions. How do you decide whether a simple strike-off is sufficient or whether a solvent liquidation is the right route?
Thank you for that question. There isn't any hard and fast rule about it. It does come down to commercial decisions and risk. If the kind of questions I would ask if someone presented me with that question, you know, what did the company do? How long it's been dormant? Are there any historic claims that have been raised in the past? and is it foreseeable that you might see something come out of the woodwork? You know, if you've got a company that previously did construction in the 1950s and there's risk of sort of asbestos related claims, then I would definitely recommend a solvent liquidation, because whilst you might not reasonably foresee any claims, there is a risk that some might arise, and it would be better to have a proper structure in dealing with those. Whereas if you've got something with absolutely no risk of claims, then a strike off might be much more straightforward and sensible.
Thanks very much, James. So if in doubt, maybe speak to a professional advisor like yourself about the level of risk that might be embedded within each of those entities.
Yeah, of course.
Great, thanks very much. Sam, I've got one for you here from Jonathan. Jonathan has asked, can you confirm the threshold for large companies on QIPs are quarterly instalment payments? We are a group. Is the threshold 1.5 million divided by the number of companies or an accumulation?
Yes, of course. So the £1.5 million threshold is divided by the number of group companies. So if you have 3 companies in your group, so you've got a holding company and 2 trading subsidiaries, it would be the minute one of the companies is tripped 500,000. So you would need to look at each company. So if one company trips, that company's in quarterly instalments. The other company might still be in the 9 months regime, or if you had a loss-making company, you would look at how you would allocate those losses, perhaps try and keep companies below those limits and keep them out of quarterly instalment payments for as long as possible. So yeah, those limits are divided by the number of group companies you have.
Okay, thanks, Sam. So important to look at that on a company by company basis, bearing in mind the whole number of companies in the group. Because if one in is not all of them in necessarily, and perhaps do some forward planning and looking early, because quarterly instalments, as you said in your presentation, can bite you earlier than maybe you anticipated. Thanks, Sam. And I think we've got time for perhaps one final question. Graham, it's for you to answer. It's from Angela. She said, our auditors asked for much more detailed cash flow forecasting this year, including downside scenarios. Is that becoming the norm? And what level of evidence should finance teams be preparing before the audit starts? Thank you very much. Have we lost Graham? He's back.
This is absolutely becoming the norm. And this is part of the push from regulators and from audit technical staff such as myself. Really, when auditing anything that has an element of estimation uncertainty around it, as a finance team, you should be breaking that down into the individual assumptions. So if you're forecasting cash flow, for example, using revenue or EBITDA is not really an assumption in itself. It's the output of a number of other assumptions, right? For example, revenue, classically made up of volume and price assumptions. And so you should have evidence to support each of those. And of course, it's good practice to have a baseline, an upside, and a downside sensitivity to those. Now, auditors should absolutely be asking for that, because it's difficult to audit otherwise if we're looking at things in aggregate. And actually, it adds a lot more value when they're able to assess what is a worst case and what is a best case, or what's a downside and what's an upside scenario. They can look at the boundaries of uncertainty and then come to a conclusion about whether either there's an issue with going concern or the valuation of an asset is X or Y. Do expect it more and more. And if your auditors aren't questioning you on this or pushing for this, I think as a finance team, you should absolutely be looking at this as a matter of good governance anyway.
Thanks very much, Graham. Well, with only a few minutes left till 11 o'clock, I think it's time to say thank you to everyone who submitted their questions today, and thank you to our panel for sharing their insights and expertise. If there is one thing I've taken from today's discussion, it's that finance leaders continue to play an increasingly strategic role within their organisations. The challenges may evolve, but that need for clear information, good governance and performance planning remains constant. So I go on to say that if your question hasn't been answered live today, we will make sure the appropriate member of our team follows up with you afterwards. And before we sign off, I'd just like to let you know of another webinar we're holding on Wednesday, the 15th of July. It's for another Finance Focus event, but it's aimed at business owners. So some of you may wear that hat as well, or know someone who does. So please do feel you can recommend this to them. Our experts on that panel will explain what has changed, what opportunities remain, and why now is a critical point for action, particularly when succession, ownership transition, and long-term family or shareholder objectives are involved. So if that's of interest to you or anyone you know, please do scan the QR code on screen that's there now to register your attendance. So that just leaves me to say that on behalf of everyone at Kreston Reeves, thank you very much for joining us today. We hope you found the session useful and that you've taken away some practical ideas to apply within your own organisations. As I said at the beginning, before you leave, we'd be really grateful if you could just take a moment to complete the short feedback survey. It really helps us improve for future events. And that just leaves me to say that I hope you all have a great day, everyone, and thank you again for joining us.